Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Dave Weisberger, co-founder and CEO of CoinRoutes, to discuss the importance of market makers and market structure, particularly as it comes to trading crypto. Dave, it's great to see you as always, although we're virtual for the first time. Over the past couple of years, we've been working together. And this is an important topic because of all the kinds of trading that we've seen in the first quarter of 2021, and really the niche that market makers are in, the risk that they take on, and the type of market structure that they provide. And I think a lot of this is widely misunderstood.
I think it's incredibly misunderstood. I'll never forget sitting as the GameStop situation evolved, sitting in my gym in New Jersey, which is a glorified garage, but I had a TV in there so I could be on a bicycle and spinning, and watching the CNBC chart of GameStop going up, down, up, down, up, down, up, down in crazy whatever. And the first thought that hit my head is, if anybody wants to know what the market looks like in a volatile asset without market makers, this is it. Because that was during the period of time when they literally couldn't borrow it. And if market makers can't borrow, they can't short. And if you can't short, you really pretty much aren't going to be able to bid either. And so market makers were just absent for a while, except for some of the retail market makers, but certainly the on-exchange ones were gone. And when they're gone, or they're widening their spreads, this is what you get. And it amazes me that people see that and don't make the connection to how important market makers are to assets and to liquidity in assets. Because let's face it, there's this time element, right? When you have people, someone demands, if let's say in 1 second, someone wants $10,000 or $100,000 of an asset, and no one is there to sell them at that point. And then a minute later, someone wants to sell it. Well, it's going to go up then down. Now, we've seen that smooth out, like in Bitcoin, in the crypto world where I live. We see that all the time, where people get a little excessive and it goes up and then straight back down again. But the reality is there's a lot of market makers now. And so those sorts of candles are far smoother now than they used to be. It may not seem like it when you're looking at the size of them, but you have to take it in perspective. The actual average kind of candle move size today in dollar terms is similar to what it was, well, a year or so ago, but the price of the asset is 5 times higher. So in percentage terms, there's dramatically less of that, and that's because market makers are getting better and better and more connected. So it really is important.
Yeah, and Dave, I feel like market makers sometimes get a bad rap, particularly in financial media. I mean, at the end of the day, they are the ones that are taking on 100% risk to make fractions of a penny, right?
I mean, yeah, I was on Twitter defending Virtu. Now, I never worked for Virtu. I did help start the market maker at 2 Sigma Security, so I do understand market making. But the reality is, it is amazing to me how people demonize anyone who has a business that is a profitable business. Sometimes, I mean, that seems to be what's happening. I mean, Doug Sifu, who's their the CEO, he's very honest about it. He's given a bunch of interviews recently, and the reality is, market makers are in the business to provide liquidity. They charge for their service, they make money, and the liquidity they provide generally provides an advantage to the people they're providing it to. So retail investors generally get a better trade in equities, at least, than people who don't have a market maker to go directly to. And the fact that there are market makers on the exchanges make it better for the institution. So in general, it's better, but they're not altruistic by any stretch of the imagination. They're doing it to make money, but it takes a significant infrastructure investment as well as talent and risk investment to be able to do it. And so it's one of those things that every once in a while you get too many people in the business, it gets overbroked, over market made, and margins fall, and then people fall out of the business and spreads widen, and then they start tightening again, and it goes in a cycle. And it always is, like any other business.
And would you say that market structure around crypto is improving? It certainly seems like it has.
Well, I mean, the crypto market structure has been advancing pretty consistently. It is still different and will always be different than equities, which I came up with, and we at CoinRoutes, we're right in the middle of that. So I think I've explained this to you before. At crypto, in equities, you have these arguments about sub pennies, whether we should do that or not. Phil McIntosh, your Phil McIntosh has a great paper out, which he's advocated for, which I've always agreed with him on, for intelligent tick sizes. The reality is, in crypto, the tick sizes more or less are set by the market, Whether they're intelligent or not, what I can guarantee you is that they are not limited. So Bitcoin has a penny tick size. It's a $50,000 instrument. That doesn't mean that it ticks, that the bid offer is always a penny, although it can be. The fact is that what happens in crypto is markets adjust faster than they used to. There's still inefficiencies in markets in the crypto world, because if you're trading on one exchange, let's say Coinbase, and you have Bitcoin there, but you don't have Bitcoin on, let's say, Gemini. And then what happens is the price of Bitcoin goes higher on Gemini than it is on Coinbase. You have to transfer the Bitcoin from one to the other to be able to sell it to narrow that gap. What's happened over the last few years is there are services now and ways of transferring that have gotten substantially faster. And so those gaps, when they happen, don't last nearly as long. And there's a robust lending market, which you've probably heard about, where people can borrow to be able to take advantage of those things and keep those spreads more in line. The result from a trading point of view or an investor point of view is that the market structure is far more in line than it ever was. That doesn't mean that it's perfect. Software such as ours, which helps you know whether the prices are in line, is very important because it will help you do better. But on the marginal basis, it's certainly improved quite a bit.
All right, Dave. Appreciate the insight. Great to catch up with you as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.